Welcome to Holistic Accountant Podcast, where we aim to showcase how adopting a holistic approach in accounting and tax maximizes value for clients. Beyond traditional tasks like preparing financial statements and tax returns, a holistic accountant focuses on offering advice that maximizes personal wealth on an after-tax basis. If you enjoy this episode, please consider leaving a rating and sharing it with those who might also benefit. And to ensure you stay updated, subscribe to our weekly email. The link is in the show notes. Okay, today Mena and I would like to talk about payroll tax liabilities and something that a few states around Australia are on a bit of a warpath about. So let's talk about the issue. The issue is that some state revenue officers or Office of State Revenue, depending on which state you're in, they've got different names, but the state-based entity that levies or deals with payroll tax, a lot of them are trying to obviously raise tax revenue because particularly over the COVID period, a lot of the states have got themselves into quite a bit of debt, particularly Victoria. Thanks, Dan. And they're looking obviously to raise tax revenue, repay that debt, and so I think that's as a general sort of warning for people that run businesses, invest in property. You need to be aware of that because they're certainly on the warpath with land tax as well. But anyway, with respect to payroll tax, what they're trying to do is target businesses that don't have employees, that have independent contractors or service providers, and argue those people are actually employees. And if they win that argument, then they can levy payroll tax against that entity. And New South Wales is particularly active in this space. But trust me, if New South Wales is successful in doing that, I guarantee all the states will follow in their footsteps. So it's something to be really conscious of because it can have, significant, they go back 5 years and levy payroll tax on 5 years of payroll that, you're up for a lot of already liability plus interest and maybe even penalties if they get really aggressive. So, Mena, what sort of businesses are impacted by, this sort of situation?
So New South Wales has gone after medical practices initially. So basically, a lot of medical entities and allied health professionals use service agreements. So what that is where the clinic would generate the patient fees or hold the patient fees on trust for a respective medical practitioner, and then disperse a certain percentage of those patient fees to the medical practitioner and retain some as a service fee to cover their costs, such as rent, salaries, and so forth. Now, they're basically saying that the practitioner, that service agreement, that practitioner is considered to be an employee, and that practitioner is then almost as such as like a labour hire arrangement and should fall under the payroll tax category. Now, if you're a large medical practice, or not even large, if you're a small to medium medical practice, depending on what state you are in, it can very easily tick over the payroll tax threshold between your wages, between your doctors and your receptionists and so forth. It's very easy to get over that sort of threshold. And as Stuart mentioned, they go back 5 years, so that liability could be somewhat significant. Now, they're going after these medical and allied health entities. There's a lot of other arrangements that are common to this, such as mortgage brokering services.
Yeah, so New South Wales is trying to go after aggregators. So an aggregator is a business, a service provider that a lot of mortgage brokers use. And what happens is they have the agreements with the bank. And the bank pays the aggregator a commission and then pays that on to the mortgage broker, and the aggregator might keep either a fixed fee or percentage for providing services such as software and compliance and those sorts of things. To my mind, that aggregator relationship is not even, doesn't represent or resemble an employee-employer relationship by any stretch of the imagination. But I think we can take it as an indication of how aggressive certainly New South Wales has been in this regard. And as I said at the beginning, if they're going to be successful, then look out, all other states will follow. So, Mena, what can we do about it?
So the first option is actually is to put all your contractors as employees or labour hire arrangements. So that means, yes, additional work cover expenses means you have to remit super for them. There's additional compliance in the fact that, more payroll processing that you have to do and more PAYG that you need to withhold. And more likely than not, it'll still get you over the payroll tax threshold. A secondary solution.
So obviously that's not
a great
solution.
No. It's not a great solution. So the secondary solution is to basically have the practitioner or whoever's deriving the patient fees actually own all the fees. So, for example, if we use the medical practice as an example, have the doctor that's earning those fees, that 100% of those patient fees go directly into that doctor's bank account, a bank account that's solely controlled by the doctor, and then they will pay then the service fee for their share of costs associated with the rent, the wages, and any other overheads of the medical clinic back into the clinic. Now, it's not a perfect arrangement. It's really important to get the legalities behind it correct, to have the service agreements drawn up correctly by someone that understands the law well, and make sure that you have the right advisors behind you to make sure that there is no exposure to the payroll tax issues that we've just discussed.
And also, something to be mindful of, if the states are successful at raising more payroll tax revenue as a result of arguing that people are employees, the federal government is going to be behind them in the queue, then asking for superannuation guarantee contributions. Because if the state is successful in arguing that they're employees, then the federal government is going to turn around and go, well, not only did you pay those people a salary then, you now have to pay a superannuation guarantee. So you could be up for another sort of 10 or 11% on the expense.
And the associated, sorry to cut you off, and the associated interest and penalties, because those are quite hefty for back payments of super.
Yeah, and and they're not deductible either, are they, Mena? Yeah, so you've got a big expense there, but you don't get a tax deduction for it. So I guess what we're saying is you need to be on top of these things. And I'm not convinced that, or I should say we're not convinced that there's a perfect solution yet. But it's something that's a very live issue and one that you need to be talking to your holistic accountant about, particularly if those arrangements are going to impact you. Now, if you don't use any sort of contractors or service providers in that way, then don't worry about it. But if you do, it's something you need to be on top of. Okay, that's it for this week. Until next week, bye for now.